Welcome traders, Matthew here from Taurus Trading. In this video you will learn how to gain more accuracy in reading market structure, but most importantly how to use this knowledge to become more profitable in your trading, so stay tuned. Candlesticks formations build patterns that predict price direction once completed. Steve Nison brought candlestick patterns to the Western world in his popular 1991 book Japanese Candlestick Charting Techniques. Many traders can now identify dozens of these formations. In addition, single bar patterns, including the doji and hammer, have been incorporated into dozens of long and short side trading strategies. Obviously, not all candlestick patterns work equally well. Their huge popularity has lowered reliability because they've been analyzed by hedge funds and their algorithms. These well-funded players relied on lightning speed execution to trade against retail investors and traditional fund managers who execute technical analysis strategies found in popular texts. However, reliable patterns continue to appear, allowing for short and long-term profit opportunities. So first, let's talk about counterattack lines and its bullish version. Following a white candlestick in an uptrend, the market gaps sharply higher on the opening and then closes unchanged from the prior session's close, a pattern which reflects a stalemate between the bulls and bears. The opposite is true for bearish counterattack lines, so following a black candlestick in a downtrend, the market gaps sharply lower on the opening and then closes unchanged from the prior session's close, a pattern which reflects a stalemate between the bulls and bears. Next one is bullish belt hold, which is a tall white candlestick that opens on its low. It is also called a white opening shaven bottom. At a low price area, this is a bullish signal. A bearish belt hold is a long black candlestick which opens on its high, also referred to as black opening shaven head. At a high price level, it is considered bearish. Now let's talk about so-called dark cloud cover. This is a bearish reversal signal. In an uptrend, a long white candlestick is followed by a black candlestick that opens above the prior white candlestick's high. It then closes well into the white candlestick's real body. Doji is a session in which the open and close are the same or almost the same. There are different varieties of doji lines such as gravestone or long-legged doji, depending on where the opening and the closing are in relation to the entire range. Doji lines are among the most important individual candlestick lines. They are also components of important candlestick patterns. The bullish doji star pattern is a bar formation that develops after a down leg. The first bar has a long black body, while the next bar opens even lower and closes as a doji with a small trading range. The final bar then closes above the midpoint of the first day. On the other hand, the bearish doji star pattern is a bar formation that develops after an up leg. The first bar has a long wide body, while the next bar then opens even higher and closes as a doji with a small trading range. The final bar then closes below the midpoint of the first day. A bullish engulfing pattern is comprised of a large white real body which engulfs a small black real body in a downtrend. The bullish engulfing pattern is an important bottom reversal. The opposite is true for a bearish engulfing pattern. A major top reversal pattern occurs when selling pressure overwhelms buying pressure as reflected by a long black real body engulfing a small white real body in an uptrend. Now let's talk about harami. This is a two candlestick pattern in which a small real body holds within the prior session's unusually large real body. The harami implies the immediately preceding trend is concluded and that the bulls and bears are now in state of truce. The color of the second real body can be white or black. Most often, the second real body is the opposite color of the first real body. Bullish harami cross is a harami with a doji on the second session instead of small real body, an important bottom reversal signal, especially after a tall black candlestick line. It is also called a petrifying pattern. On the other hand, bearish harami cross is a harami with a doji on the second session instead of small real body, and it's an important top reversal signal, especially after a tall white candlestick line. It is also called a petrifying pattern. Morning star is a major bottom reversal pattern formed by three candlesticks. The first is a long black real body, the second is a small real body, white or black, which gaps lower to form a star. The third is a white candlestick that closes well into the first session's black real body. Morning doji star is the same as a morning star, except the middle candlestick is a doji instead of a small real body. Because there is a doji in this pattern, it is considered more bullish than the regular morning star. We also have an evening star, which is a major top reversal pattern formed by three candlesticks. The first is a tall white real body. The second is a small real body, white or black, which gaps higher to form a star. The first is a black candlestick, which closes well into the first session's white real body. An evening doji star is the same as an evening star, except the middle candlestick, in example the star portion, is a doji instead of small real body. Because there is a doji in this pattern, it is considered more bearish than the regular evening star. Now let's talk about hammer. This is an important bottoming candlestick line. The hammer and the hanging man are both the same line, that is a small real body, white or black, at the top of the session's range, and a very long lower shadow with little or no upper shadow. When this line appears during a downtrend, it becomes a bullish hammer. For a classic hammer, the lower shadow should be at least twice the height of the real body. The opposite is true for inverted hammer. Following a downtrend, this is a candlestick line that has a long upper shadow and a small real body at the lower end of the session. There should be no or very little lower shadow. It has the same shape as the bearish shooting star, but when this line occurs in a downtrend, it is a bullish bottom reversal signal with confirmation the next session, in example a white candlestick with a higher close or a higher opening. The so-called hanging man is an important top reversal. The hanging man and the hammer are both the same type of candlestick line, in example a small real body, white or black, with little or no upper shadow at the top of the session's range and a very long lower shadow. But when this line appears during an uptrend, it becomes a bearish hanging man. It signals the market has become vulnerable, but there should be bearish confirmation the next session. In example, a black candlestick session with a lower close or a weaker opening to signal a top. In principle, the hanging man's lower shadow should be 2 or 3 times the height of the real body. The so-called piercing pattern is a bottom reversal signal. In a downtrend, a long black candlestick is followed by a gap lower during the next session. This session finishes as a strong white candlestick, which closes more than halfway into the prior black candlestick's real body, compared to the on-neck line, the in-neck line, and the thrusting line. We also have tweezers top when the same highs are tested the next session or within a few sessions. They are minor reversal signals that take on extra importance if the two candlesticks that comprise the tweezers pattern also form another candlestick indicator. The opposite is true for tweezers bottom, so when the same lows are tested the next session or within a few sessions, For example, if both sessions of a Harami cross have the same low, it could be an important bottom reversal, since there would be a tweezer's bottom and a bullish Harami cross made by the same two candlestick lines. Please note that all the candlestick patterns described in this video are meaningless if you're not using a context or bigger market picture, and I have a video dedicated especially to this subject. I will leave a link to this video in the description. Also, make sure to be aware of the fact that in markets generally not everything works all the time, so usually you should be expecting accuracy within 60 or 70% when we're talking about candlestick patterns, and of course they need to be viewed in a general bigger picture or bigger trend. So I hope you've enjoyed this video. Please consider subscribing to my channel to help me provide more educational content. Also, you might as well want to visit my website and grab a free copy of the ebook I've prepared about financial markets, and I hope to see you next time.